is do a top-down approach or a bottom-up approach, or you could combine the two and do a hybrid approach. Now, a top-down approach will start with a macroeconomic analysis. So let's say if we were talking about Samsung and we were thinking of buying some bonds issued by Samsung, we would probably start off with a macroeconomic analysis of South Korea, maybe a macroeconomic analysis of the entire global economy because Samsung sells its products almost everywhere. We'd look at the industry, the smartphone industry, right? The TV, the monitor, whatever products this company sells. And then maybe we would look at individual idiosyncratic factors of this company, right? Factors which are specifically related to this company only, company specific factors. Or what you could do is start up a bottom up research where what we are most interested in is, does the company have enough cash to pay us back with interest, right? But we can't just look at the cash flow statement because the cash flow statement is intricately linked with the balance sheet and the income statement. So we have to look at those three together. And what's really useful here is ratio analysis. And I will, of course, talk more about ratio analysis shortly. But before I go into ratio analysis, let me just talk a little bit about the top down versus the bottom up and how the hybrid combines those two. So top down begins with a macroeconomic forecast, right? And what does that mean? So let's say if I want to know eventually what is the cash that the company will be having, I won't be able to come up with a projection for that unless I come up with a projection for the sales. And to be able to come up with a projection for the sales, I want to know what's happening in the overall economy, right? Or in the overall economies in which this business is operating. So here with the top-down approach, what we do is we start off with what's the market, right? What's the addressable market? What's the market share of that market? And based on that, we can say, okay, this is our projected sales and this is our projected cash flow. Bottom up, on the other hand, will start with your balance sheet and your income statement. So the both the analysis, of course, are linked in a way, and that is what brings us to the hybrid approach, which combines the cyclicality and the bottom up features to project or forecast the company's cash flows. And this is what we usually do in reality as well, right? In reality, we will probably start off the model with a GDP forecast, but we will be using that to project the income statement and then the balance sheet and then the cash flow statement. So actually in reality, hybrid is what is mostly used. And as I said, that the bottom up part where you're mostly interested in the cash flow statement, but you cannot get to the cash flow statement because it is derived from the income statement and the balance sheet. And if you really want to do a quantitative analysis, then ratios are very, very useful for that. And this data, of course, comes from the income statement and the balance sheet, such as operating income comes from income statement, debt comes from balance sheet, right? EBITDA comes from income statement. So some of these are mixed ratios. Now, before I get into the ratios, I want to tell you that what do you compare them to? So let's say if a company has a coverage ratio of 3 times, which means their income is 3 times more than their interest expense. Their operating income is 3 times more than their interest expense, which means even if it falls by 50%, right, still it is covering the interest expense. So is that good? Is 3x good? Or what do you compare it to? So, right, so what you have to see is the industry average, and then you will know that is this company good or not, right? You have to compare it to the industry average to get a context as to what is the industry on an average doing like, and then you will be able to see if this company is healthy or not. And you can even compare it to other industries to get even more of a context. But primarily, what you need to compare it to is the same industry's average in which the company is in. And of course, higher is better as far as coverage ratios are concerned, because what you want to see is that the operating income is much more than the interest expense. So even if the income falls, still they will be able to pay the expense, right? Over here, again, higher is better, because what you want to see is that the margin is a big percentage of the revenue, right? The income is a big percentage of the revenue, which means the costs, the operating costs are low. And maybe you might want to also get into an analysis of your gross margin separately as well, right? And compare it to the industry average. Now you want to see what is the level of debt the company has compared to its earnings before interest, tax, and depreciation and amortization, because interest and tax, of course, are linked to the capital structure. So if the capital structure changes, the amount of interest will change, and therefore the amount of tax will change, because interest is a tax deductible expense. And depreciation and amortization are non-cash expenses. So what we basically are seeing here is how much, this is a proxy for cash flow in a way, you can say, that how much cash the business is generating and how much debt does it have, right? Obviously here we want it to be lower is better, so that debt is lower. Retained cash flow, we want this to be high, because what we want to see is the amount of cash that the business is generating. Is it having to pay all of that out for expenses and interest payments and stuff, or is it able to retain some of that cash, right? And then we want to compare it to the net debt. Net debt means whatever is the amount of debt that they have minus whatever is the cash and marketable securities that they have. So even if they use all the cash and marketable securities to pay off the debt, the remaining debt is the net debt compared to how much cash flow they are able to retain in the business. Right, so as discussed, EBIT margin is your profit margin, right? Your operating profit over your revenue. So of course, higher is better, which means you have more profits available to pay your interest. Coverage ratios, again, higher is better, because we want a large amount of income compared to our interest expenses, so that even if the income falls, so let's say it's 3x, even if it falls and becomes half, we still are able to pay our interest and still have a little bit left for profit. Debt to EBITDA, of course, lower is better here, since we want a low level of debt, because high leverage or high debt means high leverage, which means high credit risk. Here we want a higher ratio. We want the company to be able to retain a large amount of cash flow compared to the amount of net debt that it has. And as discussed, all these ratios have to be compared to the industry average and peers of the company with other companies who have similar credit ratings, right? So that will give you a good context as well. And you need to also monitor them for changes, because businesses change, industries change, drivers change. So you need to keep a close eye on these ratios and monitor their trend. Right. So that was your top down and bottom up and hybrid analysis, and linked with your ratio analysis. Let's take a break here. In the next one, we'll come back and talk about seniority rankings, recovery rates, and credit ratings.